We've seen a total of 12 periods since 1948 where unemployment rose in the United States. Every single one of these periods was categorized as a recession. Rising unemployment is the most important defining characteristic of a recession, according to the National Bureau of Economic Research. At the risk of stating the obvious, if people are losing their jobs, it probably means businesses are laying people off because the economy isn't doing so well. Today, a 3.9% unemployment rate does not reflect these types of conditions. If we assume that the government's data is correct and trustworthy, we have not seen a recession since 2020. Now, since 1948, the average time between two recessions has been 5 years and a half. If the economy achieves this average path today, it would mean the unemployment rate can stay low until around 2026, with the economy not entering a recession until then. But recessions don't occur just because it's been too long since the last one. As the saying goes, economic booms don't die of old age, they are murdered. Throughout history, we've seen oil shocks, pandemics, violent market crashes ignite recessions where the unemployment rate rises. Most of these are impossible to predict with any degree of accuracy, which is why many economists believe it's impossible to predict when a recession is going to occur. But all of these recessions do have one thing in common. All of them saw the housing market weaken substantially in the couple of years before the recession occurred. This is a chart that represents the strength of the housing market. It shows us how many houses are being sold in the United States over a period of 2 years. And from what we found, this has been one of the most accurate leading indicators of the United States economy over the last 50 years. Every time that the housing market weakens, we see a recession occur shortly after. In fact, when we flip this chart and we add the unemployment rate on top, you can see the unemployment rate follows what the housing market does with a lag. All we have to do is shift this chart forward by a year and a half, and we see there's almost a perfect match. Not only did housing weakness predict all of the recessions that we've seen over the last 50 years without failure, but it also predicted when economic recoveries were going to take place with a pretty good degree of accuracy. So we're challenging economists that don't believe we can predict recessions today, because housing can tell us, at the very least, when the economy is more vulnerable to go into a downturn. The reason this works is because housing is the most sensitive part of the economy to interest rates. So when the Federal Reserve raises interest rates, which they do when they want to slow the economy down, it immediately leads to higher mortgage rates, which immediately impact the demand for housing. So the housing market is the first part of the economy that really feels the impact of monetary tightening. The rest of the economy takes more time to feel the effects of rising interest rates. Banks first need to reduce their lending, which can take some time, which then stops businesses from being able to borrow money easily and cheaply, which means less opportunities for growth in the economy, so less opportunities for jobs, which means people feel less confident, so they spend less, which translates into lower sales for businesses, which leads businesses to lay people off, and finally the unemployment rate starts rising and the recession begins. This entire process takes about a year and a half, according to academic research, but luckily we have the housing market to give us a glimpse into the future and show us the damage that interest rates are going to have on the economy before it actually happens. And today the housing market is telling us that we are right on the edge of a pretty substantial weakening of the labor market. It's forecasting that unemployment could rise until the end of 2025, but this isn't going to happen overnight and in a straight line. In almost all recessions, it takes time for the unemployment rate to go from trending down to finally begin trending higher. The only exception to that rule is, of course, in 2020, where the pandemic created a massive shock to the economy. But you can see that has been the case today. The unemployment rate has been rising since April of 2023, so we've had around a year already of rising unemployment. In 2006, the unemployment rate bottomed in October. The recession started in December, also just over a year later. In 2000, the unemployment rate bottomed in April, and the recession began in March of 2001, also around a year later. In 1989, the unemployment rate bottomed in March, but the recession didn't start until July of 1990. So that was a year and a half later. So if the housing market is right about a recession again, between today and the end of 2024, we're at around that sweet spot where a recession could actually start. It's possible that it takes a little bit longer this time around, because you'll notice that a 3 3.9% unemployment rate is still very low by historical standards. So we may have steadily rising unemployment, but by no means do we have elevated unemployment today. Another reason why a recession could take longer to materialize is the massive amount of government spending we've seen over the last couple of years. United States government spending hasn't been this aggressive since the 1960s. In the 1960s, a recession didn't occur during that period of heavy government spending, but as soon as it leveled off, that's when economic downturns began. So for now, our bias on the market remains quite bullish. These technical structures that you see here are really what's guiding our short-term strategy at Game of Trades. It's simple, it might look stupid, but it works. Paying attention to key levels is what we do every day to make sure that we're staying on the right side of the market and making the right bets. Join our membership today and we'll make sure we do everything for you to be successful in markets.